While predicting the future of the housing market is always a bit like gazing into a crystal ball, let's explore some insights from experts and data-driven analyses to get a sense of what might happen in California's housing market in 2025. General market trends. Most experts in the housing industry predict less buyer demand, lower prices, and higher borrowing rates. Rate increases, along with a shortage of availability, have pushed many purchasers to the sidelines. In 2025, the housing market is likely to be a balancing act on a tightrope one. The Golden State was affected by the same price correction that hit the United States housing market between late summer 2022 and spring 2023, though prices have slightly rebounded since then, as inventory remains low to gradual thaw and stabilization. According to U.S. News Housing Market Index predictions, the housing market is expected to gradually thaw after experiencing challenges. Existing home sales are likely to rebound as mortgage rates decline. However, due to a lack of supply, home prices are expected to hold on to their gains. As lending rates fall and more homes are listed for sale, true price discovery should occur. 3. Millennials and supply-demand dynamics. Overall, while there may be a moderation in growth, the potential for a national housing market crash in 2025 seems mitigated. A surge in supply and strong demand from millennials play a significant role. However, it's essential to keep an eye on potentially vulnerable overvalued regional markets. 3. In summary, while there are warning signs and challenges, the consensus among experts is that California's housing market will likely see a correction rather than a crash. Factors like supply, demand, borrowing rates, and economic conditions will continue to shape the market dynamic. The housing market crash of 2009 was a pivotal event during the Great Recession. Let's delve into the reasons behind this significant downturn. Subprime mortgage collapse. The subprime mortgage market played a central role. Lenders had issued risky mortgages to borrowers with poor credit histories, often with adjustable interest rates. When these subprime borrowers started defaulting on their loans, it triggered a chain reaction. Mortgage-backed securities bundles of these loans lost value, leading to financial instability for banks and other institutions. 1. Housing bubble burst. Prior to the crash, there was a housing bubble. Home prices had soared to unsustainable levels due to speculative buying, loose lending practices, and unrealistic expectations. When the bubble burst, home values plummeted, leaving many homeowners with properties worth less than their outstanding mortgage balances. Foreclosures surged as people struggled to keep up with payments. 2. Financial institutions' vulnerability. Major financial institutions held significant amounts of mortgage-backed securities. As these securities lost value, banks faced severe losses. Lehman Brothers, a prominent investment bank, collapsed in September 2008, sending shockwaves through the global financial system. Other institutions were also at risk. 3. Credit freeze and economic impact. Banks became reluctant to lend to each other due to uncertainty about their exposure to bad loans. This credit freeze paralyzed the financial system. Businesses faced difficulty accessing capital, leading to layoffs and reduced economic activity. Consumer spending declined, exacerbating the recession. 3. Government interventions. The U.S. government implemented various measures to stabilize the economy. The American Recovery and Reinvestment Act provided fiscal stimulus, including tax cuts and public works projects. The Homeowner Affordability and Stability Plan aimed to prevent foreclosures by restructuring or refinancing mortgages. The Federal Reserve lowered interest rates and injected liquidity into the banking system. 3. Long-term impact. Although the recession technically ended in mid-2009, the damage was deep and recovery took years. Many people lost their homes, credit ratings, and jobs. The housing market eventually recovered, but scars from the crash remained for a long time. 3. In summary, the housing market crash of 2009 resulted from a combination of risky lending practices, a bursting housing bubble, and the interconnectedness of financial institutions. Its effects reverberated globally, leading to the Great Recession.